Fed mega interest rate hike. What the Fed interest rate hike means to your finances. The Federal Reserve rate hike could affect your savings, your debt, and your investments. Watch this video to find out how. Over the past few months, Fed officials have been sending mixed signals about future interest rate hikes. But whatever their private misgivings may be, most Fed officials will still follow through with another rate hike in September. What is a rate hike? A rate hike is an increase in the interest rate that the Federal Reserve charges banks on short-term loans. Raising banks' borrowing costs would make it more expensive for businesses and consumers to borrow money. The Fed's basic logic for raising interest rates. The Fed's job is to catch up to inflation and bring it back down to 2%. The Fed's job is to slam on the brakes with a rate hike to bring the economy back to a healthy pace. This month is likely to witness Fed's mega rate hike. Since March, the Fed's inflation-fighting measures have driven rates up aggressively. As a result, another 75 basis point, or even higher, rate hike may occur on September 21st, just as we saw at the last two meetings. How the Fed rate hike may affect investors. A rate hike could be bad for investors. A Fed rate hike raises the cost of borrowing money, which lowers the demand for stocks and drives down stock prices. What happens after this? For the rest of the year, the Fed will have to decide whether to hike rates again based on the same data they used to decide to hike in September. But a strong economy with higher inflation could need another rate hike. Bottom line: investors should maintain diversification and not be overly concerned about short-term market gyrations, irrespective of what the Fed does in September. Instead, investors can benefit from this economy if they maintain a long-term approach. It took me hours to create this video, and I would appreciate if you would subscribe and promote it. Please visit lifeandlearn.com for more information.